Hi there, my name is Kevin Carlson. I'm a mortgage broker here in Canada. Thank you so much for joining me on my YouTube channel to learn a little bit more about mortgage financing. Well, this weekend is a little bit of a red letter day for anybody who's got a YouTube channel. I just passed 1,000 subscribers on the channel here. So I just wanted to do this video as a big thank you to all my subscribers and all those who aren't subscribed and still watch the videos and comment and really bring a lot of life to the channel. So thank you so much for all your interaction with all my videos and good comments. So what I've decided to do today here with this little bit of a celebration on 1,000 subscribers is just kind of go over some of my favorite comments on the different videos that I've done over the last year and a half, and just sort of go over some of the discussion and some of the stuff that's come out in some of the comments. Some of these comments really brought a little bit extra to each video. Some of them are actually, kind of a little bit more thought-provoking, and maybe even some things I probably should have covered in the video. So I thought that this would be a good chance to kind of do a little bit of a look back and see what other people's questions might have been over a particular topic. Now, I know anytime you've got a YouTuber and you look at some of their comment sections, they can be replete with all kinds of, certainly some terribleness, but I'm pretty blessed. I'm finding the comments to be very much respectful and, kind of adding to the channel. So I haven't had anybody really calling anybody out or being just kind of nasty. So I just really appreciate all you folks who comment and just keep it positive, and that's exactly what I'm looking to do. So thank you. So just to go over some of the random, just positive comments, here's Luna Marie saying very helpful, especially times like this. Thanks, Kevin. And Patrick saying, checked out other videos on the rules, most informative. Thank you, Patrick. And then another comment here about great explanation about one of the videos that I talked about. And clean as dirt, you've always got some good comments to go here. So attention Kmart shoppers and that sort of thing. So I really enjoy some of your comments there, Mr. Dirt. And another one here, thank you, Yoda, very informative. So thank you so much for some of your good comments there, Mr. Clean as Dirt. And also Bob Prairie Real Estate. He's actually a local realtor here in Regina where I work as well. And we've actually kind of established a bit of a good working relationship, not only in real estate, but in the YouTube channel as well. So if you're not following Bob Prairie Real Estate for lots of awesome real estate content, you should be. So just go and have a look at his channel. His subscriber count's growing like crazy, and he does just a terrific job of updating people on the market locally, not just locally, but all across Canada, just as a monthly look up on the what's happening in the real estate world. So I just went back through my channel and just grabbed some comments that people made in each of these videos here. So this is the very first video I did way back in September of 2019, just regarding mortgage brokers and kind of the benefits of using us here. So Psyquality said that my bank providing a home equity loan is low as prime minus 1 or prime minus a half if they go with them. But the independent mortgage brokers have similar competitive deals, and there are other websites out there with third-party lenders. So yes, we as mortgage brokers, we can do lines of credit as well as just regular mortgages as well. There are lots of other websites out there where you can get mortgages for sure, just like lots of other websites where you can get lots of different shopping online and that sort of thing. Absolutely. I would say that we professional mortgage brokers who are not just working in a call center with one head broker working, kind of overseeing however many people might be working in that call center, we add something to it. It's a personal service. So as the mortgage broker for all my clients, I take up the application, I pull credit reports, I submit it to the lender, and I do everything right to the very end, right through to funding. The next one was on my first-time homebuyers incentive program video, and it's the question here from Amnaya was, can I repay the mortgage incentive back to the government earlier than, I think it's the 25 years is when you're actually required to, or when you sell the house? And the answer was yes. You can pay that off immediately if you want to. You can pay it off in increments. With the first-time homebuyers incentive program, where you can get 5% of the purchase price of a used home, or 10% of the purchase price of a brand new home, and basically a second mortgage from the federal government. Yes, you can pay it off right away. There's savings there where the mortgage insurance premium's a bit less. So we always encourage people to try to pay that off as soon as possible. But like I said, the requirements are when you sell the home, it has to be paid, or after 25 years. That's kind of the last marker. The next one here, Yedwinder was talking about the first-time homebuyers incentive program, where the income cap is no more than you have to have $120,000 per year of gross income, family income, and below, in order to be qualified for that program. And he was saying that maybe just he or his wife would go on to the mortgage and just leave one of them off. And my comment to him was just that I'm pretty sure that you can't just alter the application. You do need to, if you're buying the house and you're both going on the mortgage, we have to use both your incomes. I encouraged him to just give a call to the first-time home buyer folks and just double check that as well. Next one was my video on the Purchase Plus Improvements mortgages, where you actually buy a house and then get some extra funds in an improvement loan as well. And it's not a standalone loan, it's just a little extra funds when it comes to getting a little bit extra on a mortgage. So if you're buying a house and you want to renovate it right away, then there's certainly a good way to do that. First one here, what are the interest rates on a PPI or Purchase Plus Improvements mortgage if he was only doing 5% down, or her? So basically, the Purchase Plus Improvements program doesn't affect the interest rate. The interest rate's the same. It doesn't really matter whether you're doing it as a regular mortgage or as a Purchase Plus Improvements mortgage. The interest rate's the same. So there's no downside to the Purchase Plus Improvements, really. The next one was on my video on Equifax and TransUnion and how to increase your credit score. So the first one here, actually I haven't replied to this one yet, Joe, and I will do that. This one was from just last week. So for some reason my TransUnion credit score is always poorer than my Equifax score is always excellent. I realized that by requesting my reports, whenever I get a rejected inquiry, was done through TransUnion. When I was approved a request done through Equifax, also found out some of my lenders were only to Equifax. So yes, years ago, 15 years ago, when I first started in this industry, Equifax and TransUnion were quite different. We'd find big swings and differences between the two credit reporting agencies in between scores and what was on them. And that's gotten a lot better over the years. They're much closer to each other now than they ever have been. Typically, credit unions are ones that typically will only report just to Equifax, or pardon me, just to TransUnion, whereas everybody else reports to both. And that's less common now than it was back then. But we do see minor differences between Equifax and TransUnion. In the mortgage industry, we kind of lean on the Equifax credit score and the credit bureau. That's the one that we pull in our industry. But when you're purchasing a home or you're getting a mortgage, typically the other TransUnion would be pulled as well, either at the lender or at the mortgage insurer. They'll also have a look at it just to see if there's anything else on there as well. Does a goodwill letter, Nabil, does a goodwill letter work in Canada if you've missed payments on a student loan? No, basically, Nabil's talking about something that might happen in the US. He and I had a little bit of conversation back and forth on the comment section here. I'd never heard of a goodwill letter before Nabil had brought that up, and I just did a little bit of research, and I guess it's maybe something that can happen in the States, but it doesn't really happen. So what he's talking about is he has a student loan and there was some payments that he had missed on it, and he was wondering if we can get a letter just to say, hey, this is why I missed the payments and that sort of thing. Well, here in Canada, as far as I know, goodwill letters don't really work. If you did miss the payments, that's all there is to it. If you didn't, and you can demonstrate to the credit report that you didn't miss the payments, that they were made on time, then you have a much better chance. And that's not necessarily a goodwill letter. That's just a credit dispute to talk to the credit reporting agencies and let them know that, no, this is an error. There was no problems with the student loan. I didn't miss the payments, and here's the money coming out of my bank account. And unfortunately, over the years, not so much now, but about 5 years ago, we did see some issues with the Canadian student loans issues where the payments weren't always being tracked properly. So, but I think that's kind of gone by the wayside. I don't think we see that quite as much anymore. And then Maya talking about, can I have an authorized user on my credits to help my credit score in Canada? Basically, you could, if you wanted to increase your credit score and add somebody on there to add some activity, that could work, but you have to be careful because their actions and their missteps are your actions and your missteps. So it's kind of like, do I trust a reckless driver to drive my car? Well, yes, but wear your seatbelt and be cautious, right? So whatever they're doing is going to affect you. So my answer to Maya was just be careful anytime you're adding somebody onto your credit card. If you're looking to boost your credit score, that's probably not the best way to do it anyway. The next one was on 15 years of mortgage rule changes. We've seen tremendous amount of changes in our industry over the years, and I just went over kind of a history of the last 15 years. Practically every year there were changes in our industry. So if you want to go and have a look at that video, I'll link in the description as well. So Eli was talking about thanks for the great education. Our mortgage is on the 4th year, and we're planning to do some mortgage shopping soon, and we're interested in getting a mortgage and doing some refinancing. Should we look at a mortgage broker or into a bank? Well, of course, I recommended a mortgage broker. And yes, getting in touch with, if you want to renew with your current lender, that's fine. If you don't hear from them, get in touch with them well in advance. Like 6 months is not unreasonable, because generally, if you're looking to renew early, 6 months is the window where your current bank might option you to renew a bit early. Depends on what happens to rates, though. So if you're working with a mortgage broker, make sure you get in touch with your broker at least 6 months before your renewal date, because your broker can hold an interest rate for you for up to 4 months before your renewal, just in case there's any changes in rates, just to ensure that you're getting secured, the best rate secured when your renewal does come up. The next one was on bad credit in Canada, bad credit mortgages in Canada. There was some comments there. Valuable video, thank you so much there, Mark. Will private lenders work with a person who has 20% down on indeterminate credit score because they have never borrowed money before, meaning probably no credit score? If they can prove long-standing stable income, in the States it's called manual underwriting. Yes, we do have that here. So we don't call it manual underwriting, we call it sort of equity lending. And if you do have more than 20% down, that's kind of the bare minimum. If you don't have any credit, but you've rented a house or an apartment for at least a year or two, and you can get a rental letter for that, and you've got bank statements that show good positive cash flow going through your bank statements, and you haven't missed any payments, no bounce checks, that can definitely work with 20-25% down. So that was a really good question to take that further when it comes to bad credit. I wouldn't even consider that bad credit. If you have no credit, yeah, that's not great, but it's going to be difficult for you to get a mortgage with 5% down. But if you've got 20, 25, 30% down, it's a lot easier of a process. Scully, what if I had bad credit, but I had some and have good income and have good credit, but I have low income, and the lender would use my income and my spouse's credit score? Sorry, I read that off terribly. So yeah, if you've got one person who's got the income and the bad credit, and the other person who's got no income and good credit, well, that doesn't really work either. The person who is going on the mortgage, whose income we're using for the mortgage, they're the ones that have to have the good credit. If you've got somebody who is on the mortgage application, has no income, and has really bad credit, like terrible credit, then we generally leave those folks off. They're just going to drag down the application. But the other way, income versus credit, you kind of have to have both. So wouldn't it be nice, though, if you could just rely on one or the other? The next one was on mortgage refinancing, basically taking extra equity out of your house when you renew your mortgage or when you're looking to redo it. So Anthony said, when refinancing and gaining access to more cash, does the monthly payment also increase? That's a difficult question because it's really going to depend on what happens to that mortgage. Typically, yes, if you're going to add extra lending to your mortgage, and even if the interest rate is the same or even lower, typically the payments are going to go up a little bit. But if the amortization on the current mortgage right now is, say, let's 10-year amortization left, and you wanted to make sure the payments were as low as possible, say you were, this is for a rental property, and you wanted to stretch that amortization back out to 25 years, then yes, you could certainly do that. So then the payments would go down. So yes and no, Anthony, depends on what the nature of the mortgage is. So like I said, typically the mortgage payments do go up, but not always. It all depends on the particular scenario. Truth Seeker, great info. Thank you. Is it possible to get a HELOC that we only pay back on the interest? And I talked about that previously, where a HELOC is a home equity line of credit. And that's very much where you're just treading water credit-wise. Manulife One is probably one of the ones that people might have heard of the most, where your mortgage and your line of credit's all in one and all in your banking. And those typically don't go down. Like, you're just paying the interest. You're just treading water. You're not swimming anywhere. So I'm not a big fan of them, not a huge fan of doing just a pure HELOC. But not only because you don't go anywhere with your principal, but also the interest rate's typically a bit higher than it would be on a standard fixed or variable rate mortgage. So yes, we can do those. We have access to those. But like I said, they're only for particular clientele that are looking for just that sort of particular product. Next one, Erwin's talking about if you go with a bank to be approved me if I decide to refinance my house, even though I just bought a house 2 years ago. Now, Erwin and I went back and forth just a little bit. He had only bought his house with 5% down and just a few years ago. So if you're buying your house with only 5% down, after the mortgage insurance premium gets added on, you're actually borrowing 99% because the mortgage insurance premium is actually 4%. So 95% is mortgage, and then you add another 4% for the insurance premium, you're at 99%. The mortgage refinancing is only allowed once you get to 80%. So the things that have to change there in order for you to be qualified for doing a refinance would be the market where you are has to go up significantly, like a whole bunch. Your house has to be worth a whole bunch more. So if you're in Vancouver, Toronto, this might be the case. Or you've paid the mortgage down significantly as well to bring it down below that 80% level. So another difficult question to answer. And there's also doing the purchase plus renovation with improvements where you can actually renovate the house, but you have to establish what the value is today versus after your planned improvements are done, how much it's going to be worth later on. But it still has to be to that 80% level. So the worthy crew, can I refinance and use cash to buy a second house? Absolutely. That is a really common thing that we do, where if somebody has a current home and they've got lots of equity in it, so either it's paid for or it's worth maybe 3 times the amount of what they have their mortgage on, then yes, we refinance that house, grab the equity out of it up to 80%. That's the maximum you can do, up to 80%. And then use that cash to go towards the next house as the down payment. And yes, we do that quite often. 666 Dynamax, I'm not sure to refi to do renovations or fold in credit card debt is a great idea. Credit card debt is kind of like a drug addict. Pretty likely they're going to find another hit, clear the debt, rack it up again. I think it's on this way. You would go to the bank and say, nah, I'd like to put $1,000 lien on my house to buy TV. Well, I appreciate the comment. It's a little bit simplistic. You don't really know the situation that people are in. Sometimes people have, 18 and 9%, interest rate on their credit cards and they're looking to refinance it in. Yes, for sure. That's a great idea. But I agree with you in that going to the well too many times, you're just never paying your house off. I absolutely agree with that. But it's just about managing people's expectations, right? So you can't stop people from, abusing lots of different kinds of things out there, and credit is no different. So as a broker, it's my job to try to coach people a little bit and make sure that they're not just going back to the well and just leaving that mortgage like that for 30 and 40 years and just never paying it off. So yeah, definitely it's a fine line, but we want to make sure that we're not, putting people in a crib and just saying, you don't do that. People are still free to do whatever they want. So kind of agree with you, but, walk a mile in somebody else's shoes before you judge them. Justin, are there taxes on the money you get from the cash out of refinance? Justin, thank you love the thumbnail. You're never ever going to find me talking about taxes, financial planning, or anything like that. As a mortgage broker, the term is hold out. I cannot hold myself out as a financial planner, a tax advisor, a lawyer, or accountant, or anything like that. You will only hear about mortgages and credit and lending from me. You're not going to hear about any of that other stuff because I'm not licensed to talk about it. So I'm not going to ever give any advice on taxes. However, as a layman's, my understanding of it, if I was just a layperson, talking to a friend, I'd say more than likely, no, there is no income taxes when it comes to a cash out refinance on your own home. If it's a rental property, there could be, but these are instances where you need to talk to your accountant and just to be sure that there are no income tax exposure whenever you're looking to do refinancing. So zero down mortgages, there was some comments about that where you're basically borrowing the down payment on a line of credit or a loan or something like that to use as your down payment. What if the applicant already has a line of credit? Is the draw still additionally included in the DSR or the debt ratios automatically considered as a minimum line of credit? Use it included as a line of credit is maxed out. So basically, yes. So if they've got a line of credit and there's a zero balance on it or whatever the balance is, the down payment is going to be coming from that line of credit. We have to use how much they're going to owe on it once they're using it for the down payment. And then we have to use 3% of how much is going to be owing. So basically, yes, Chad, we have to use that line of credit, how much it is. So it's not just how much you actually pay on that line of credit, how much the bank requires, but it's 3% of how much you're going to be owing on it. So that 5% comes out of there. We have to use 3% of that. Ocean, is it possible to get a mortgage on a home in a foreign country? Now, Ocean, when I replied to this, if you're watching this video, I said I can only do mortgage lending in Canada, and that's correct. It's kind of a simplistic response, but I'll put a caveat on there. We can do mortgage lending in Canada if you own a house here and then you want to purchase a house, say in Mexico or in the States, then use those equity takeout funds in like a refinance to purchase property elsewhere. So it's kind of, if you want the mortgage on the house in that foreign country, in the US or in Mexico or wherever you're buying, no, it's not something we in the mortgage industry, brokers anyway, we can't do that. But if you're looking to secure it against the house you have here, if you have a house that's paid for or you've got enough equity in your own home to be able to do a refinance to get those funds out, which I've done before, to purchase a house or a condo down south or something like that, then yes. So kind of answered that almost a year ago, maybe a little bit too quickly, and I should have maybe clarified. So yes, we can, but it has to be on a property here in Canada. Lisa, thanks for the info. Trying to purchase a home as a single mom for last year, and she's got 10% down. Her job is permanent, and she's got excellent. I have no debt and credit's very good, and she's a single mother. So my reply to Lisa was that basically I feel for you. Like, depending on where you live in Canada, it can be really, really expensive for an individual to purchase a home. It's pricey. If you're in around Toronto or in Vancouver or even in Montreal, there's some big price differences there. And just using one income to qualify is pretty difficult, especially with the stress test. So 5 years ago, we could approve people for quite a bit more because we didn't have the stress test back then. But now it's much more difficult. Now, my reply to her was that some of the retail banks, Scotia and TD, the retail banks, the big five, they typically don't use specialized income like child tax benefit, but our broker lenders, quite a few of them will allow that. So if that's one of your incomes, then we can certainly allow that income to be qualified when you're being approved for a mortgage. So I sort of feel for Lisa, but yeah, I certainly get that. It's difficult to get approved these days when, depending on where you are in the country, there's some runaway kind of house prices going on for sure. Austin and I had kind of a good conversation going at 20 to 25% down. He's talking about, he's basically being told to save up a bunch of down payment, potentially maybe a family member, parents or something like that, saying don't pay the mortgage insurance premiums. I certainly get that, Austin, and timing your purchase where you've got all your down payment to save that mortgage insurance premium. But if you're going to save, between, maybe you say you did a full 5% down payment rather than the 20%, you pay that 4% mortgage insurance premium. But what happens if you bought a house and then the real estate market locally went up by 10%? Well, then you're not saving hardly anything there. Yeah, you saved up over a year or so to save on the mortgage insurance premium, but then the house costs you 10, 15, maybe 15% higher than if you bought it earlier. So for sure, getting into buying a house, people talk about timing the market and stuff like that. Think of it this way. If you're paying rent, if you're living at home, it's not the case, but if you're paying rent, you're paying on a mortgage. It's just not yours. So you may as well get in as soon as you can rather than throwing your money away on rent. Markets like Vancouver and Toronto, they're fairly volatile. So, timing the market there is much more important. But the rest of the country, Alberta, Saskatchewan, Manitoba, out east, out west, there's, good deals to be had wherever you are. If the market's volatile, going up by 5%, 10%, why wait? Why would you want to pay rent when you can get qualified for a mortgage and buy a house now? So yeah, I'll put up some of Austin's comments back and forth here on the video that he and I talked back and forth about. Sean, with this province starting to allow companies to allow rent payments to be a liable source for data when it comes to buying a home. Now, so he's talking about rather than just a standard credit, your credit score and that sort of thing being used as your credit and just being able to use rent. My comment back to Sean was that even though the rent doesn't show up on your credit report, it can be used as an extra credit item. And his comment was, how come we can't just use the rent as qualified for a mortgage? Well, if you're trying to get approved for a mortgage for hundreds of thousands of dollars, the bare minimum is kind of just to have a credit card of at least $1,500 for 1 or 2 years. And in the grand scheme of things, if you're trying to take out a mortgage for hundreds of thousands and amortize over 25 years, that's a low bar of entry. You really need to demonstrate to the banks that you've got excellent credit for at least 2 years for them to give you hundreds of thousands of dollars. We're not talking about financing, a TV. We're talking about a house, and the foreclosure process can be pretty, huge for banks, and they take big losses on them, and that's why the mortgage insurance premiums and the mortgage insurers are there. So I do agree with you, Sean, but getting that credit, getting yourself established, that's just the game, and you definitely have to play it. Now, I just did a video on mortgages explained in Canada, just kind of the different terms and fixed, variable, amortization, that sort of thing. King Patel is talking about he's got a work permit and he's looking to purchase a home in order for it to be rented out to students and stuff like that. But he was talking about doing it as 5% down. If you're purchasing a home with less than 20% down, like just with 5% down, that's a house for you to live in. If you're buying a house with 5% down with the intent of renting it, that's actually not allowed. If you're buying a house with less than 20% down, you're going to be signing a statement at the lawyer's office saying that this is going to be your principal residence. And once you've done that, and then say 6 months down the road you want to buy yourself a house for yourself, well, they kind of know that. So you're going to have to explain as to why you bought this house with 5% down. Now you're buying another one with 5% down. So the rules are 20% down for rental properties and 5% down or under 20% down for a house for yourself to live in. Now this is mortgages for new Canadians, people who just come to Canada. Sunil, great video. I just want to know whether I need to have 2 years of employment history as a temporary resident. And that is no. So if you just come to Canada and you're here as a permanent resident or temporary resident on a work permit, as long as you've been here for at least 1 year to establish your credit, that is kind of the marker. You need to be able to have at least 1 year of rent being paid to whoever you're renting, it's a house or apartment, and then have at least that credit card for at least 1 year, at the very least. Sometimes it's a bit longer, but your work history really has nothing to do with it. As long as your employer is saying that you're full-time and permanent at your job, you don't have to be there 2 years, but the credit is what has to establish itself. So it's not so much about your job, it's mostly about your credit. Jenny, great info. Newcomers able to get a mortgage for rental properties, the same as down payment as personal mortgages. Yes, newcomers to Canada are allowed to get rental property mortgages with 20% down, but the mortgage lenders typically like to see that you've got a house of your own and a mortgage of your own on your own house rather than buying rental properties, because they see that as you're putting your roots down here and you're owning a house of your own to live in. It doesn't seem reasonable that you would rent an apartment and then just buy rentals, buy houses to rent out. They want to see that you've got some roots here and be able to establish that you're going to be staying in Canada and you're not just buying up rental properties just as an investment. It's possible, but I think each case kind of has to be looked at individually. Now, just about the mortgage stress test here, about 2.99 versus 5.19. The stress test rate's a bit lower than that now. Clean as dirt again. If the interest, say, is 1.8%, the applicant would get, say, 2.3 due to the low credit score, is the additional 2% stress test added. So what he's talking about is that the stress test is actually, it's either the rate you're getting plus 2%, or 4.79 is what it is right now. It's going to be the greater of the two. Now, pretty much it's almost always going to be the actual benchmark, not the rate that you have. Until rates start to climb up a bit more, hard to say. But it's going to be very much in that vein. That 4.79 was actually higher than what he was talking about. So that we still use the benchmark rate. This is talking about mortgage deferrals during COVID a year ago. So just how the banks responded to that. Mr. Winston talked about how the banks are profiting off the pandemic and being criminal, and that this wasn't acceptable. Now, this is the closest thing I have to kind of a off the edge, off the rocker sort of a comment. Not really, but just I certainly feel your pain. It was a pretty scary time 11 months ago. Now the banks, they didn't profit, and they didn't foreclose on people, and they could have. So that's the other side of the coin. If you look at what happened a year ago, where the banks just decided we're going to defer payments for people and keep them in their homes, the banks didn't have to do that. They could have just said, we're taking your houses. We're going to start foreclosing. End of story. So maybe look at it that way. that, you have the opportunity to stay in your home and basically shut off the foreclosure for a full 6 months and get interest relief. So, I get your frustration, Winston, about, kind of how the banks are profiting, but they run the world financially. So if you're trying to say that the banks should lose financially, they can't. If the banks lose financially, that's not good for us either. We need the banks to survive and to profit in order for our system to be viable. So definitely disagree with that. I definitely, not the best comment. I can certainly see where there was some frustration there, but maybe think of it that way there, Winston, that, if you didn't lose your house, consider yourself lucky. This is the new requirements that came out back in June with CMHC. Wasn't much news back then, right at the beginning of the pandemic. So Sharon talking about wants to have my condo paid insurance at one time, $9,000. Is that normal? And it looks like she was not going to be staying in that property for 25 years. Now, unfortunately, Sharon, and I commented to her, yes, that mortgage insurance premium is, it's like getting a ticket to Disneyland. If you get a ticket to Disneyland, you just go in and grab a hot dog and walk back out again. It's the same price, whether you stay there for 15 minutes or for the whole day. So unfortunately, the mortgage insurance premiums are a set fee. All of them are the same. The percentages are the same, and that insurance has to be paid, just like any other insurance premium. So unfortunately, no, it's not a prorated thing when it comes to the mortgage insurance. And Jason, how about borrowing RSPs as a first-time home buyer? Yes, absolutely. That is definitely one of the ways that you can purchase a home in Canada. And you just basically, I believe the $35,000 is the maximum that you can draw out the RSPs. You're actually not borrowing against them. You're actually taking them out. So those RSPs will no longer be in that account. And the government says, hey, we're allowing you to take those RSPs out, and the tax benefit you got from having those RSPs, we're going to put that on pause for a while you use it as a down payment on a house, and then just repay those back a little bit later. So yes, absolutely, Jason, you can definitely use RSPs to purchase a home, maximum $35,000 as of today. There's new cashback programs that came out with RMG Mortgage and MCAP are two of our really good lending partners when it comes to those products, and we did quite a few of them over the year, and there was some comments about it. Thanks for creating these videos. Thanks, VFX. Question, please don't get me wrong. Why would I go with a broker when I can go to websites like RateSpy and that sort of thing, and just get these sort of regular online mortgage companies? Yeah, like I said before, you can definitely go online and get a mortgage from there. You can order lots of stuff online, but are you getting the advice? So, and I'll kind of liken it to if you're selling your home and buying another one, would you want to be calling a call center to make sure that your mortgage is fully approved? So you've sold your house and you're counting on a call center person to make sure that mortgage is approved to buy the next one. I don't know. You're gutsier person than I if you're going to go off and use one of these online call center people. I don't often talk about those guys. They're definitely out there. There can be some deals to be had, but definitely buyer beware. Collateral versus standard charge mortgages. Go over the differences there. Lap was talking about, so are the other three banks the only ones offering, other three banks only offer standard charge mortgages, only TD and Scotia offer collateral? No. So if pretty much all the banks, the main charters, I believe, they all have collateralized mortgages available, but TD Bank is the only one that all of their mortgages are collateral charged. That's what I talked about in that video. Kind of not really the proper answer when it comes to whether it's a collateral or not. All TD ones are, and some of the Scotiabank ones are. And so if you get a mortgage with a line of credit, that's typically done as a collateral charge if you're going to be doing some extra borrowing later. So that's kind of the answer there, Lap. I think I answered to her properly there. Erwin, we went back and forth a bit. In order to refinance your mortgage, it must be set up as a collateral mortgage. No. So basically, if you can you can actually redo your mortgage just as a standard charge mortgage. If it's with TD, then it has to be done as collateral. But if you're doing a collateral charge mortgage, that just builds in extra borrowing later. So if you wanted to continually, refinance your property and get extra borrowing and just keep the mortgage going up, then a collateral charge is definitely the way to go. But no, Erwin, it doesn't have to be a collateral charge mortgage. It's just kind of a different product. Learn to think free. When is it good to use one or the other? I just talked about that. So the standard charge mortgage is where every time you do anything with the mortgage, if you're looking to refinance, take extra equity out, it has to be recharged every time as a standard charge. Whereas the collateral mortgage, it basically sets it up for the entire amount, and then you can just go back to that every time. There's no re-registration on title, and your borrowing is all with that same one bank. So TD just allows you to draw extra money out of the equity as you want, up to that 80% level. Scotia also does that. RBC, pretty much all the big five, they'll allow you to do those collateral charge mortgages where you can add extra borrowing onto your mortgage components later on. This is mortgages for self-employed. And hi, Kevin, like your content. Do you plan on talking about other options availing for tax benefits for home and mortgage interest? Once again, I'm not a tax specialist. You will never hear me talking about the advantages from a tax perspective. So my comment back to him was just, I don't talk about that. I'm not licensed to talk about that. I hold myself out as a mortgage broker and talking about credit, and that's it. So that's all you're going to hear from me. Essential flooring coverings. Can you use T5 income from your corporation? Basically dividend income. Yes, you can use dividend income to qualify for a mortgage when you're self-employed. If you T4 yourself, that's one way. If you're using dividends, that's another way. You can certainly use that as well. Talked about the mortgage application process, some of the comments there. Can you get pre-approved with only 1 year of work history after graduating from college? No, as long as, like I said before, if you're full-time in your job and you're not on probation or anything like that, you can get pre-approved right away. Actually, I can pre-approve you even before your probation is up. As long as you know what your income is going to be, we can pre-approve you. That's not a problem. If you're on a probation period, you're fresh out of school for, say, 6 months or a year, that might be a little bit different. If you're highly skilled, like if you're an engineer and you say you were in a co-op program and you were working with that same employer kind of on during your co-op program time with them, then even if you're on probation, it's still possible to get a mortgage, and that's something that we can maybe even do. But once again, case-by-case basis, Hassan. Only allowed to do 1 year tax returns if you're incorporated. My comment back to them was that by and large, yes, we kind of need, we need 2 full years, or no, we need 2 years of full self-employed income. But there is some programs out there where if you were in the same industry, so if you were, say, an electrician, salaried, working and getting income at a certain level, and then you became self-employed, doing the same sort of contract work, and your income was very much predictable, then there is ways to do that as well if you just become self-employed. So yes, possibly, and that's something that we might be able to do as well. Debt collection agencies and how to deal with them. Hi, I'm from Alberta. I wonder if there's a place you can go to get my credit score fixed. Fix it yourself. Watch that video. There's ways to fix your own credit. If you pay somebody to do that, you're just throwing money away. So there is things you can do. Look up online. Contact Equifax and TransUnion. They're there to help as well. Contact me if you're James. Get in touch with me. I'll help you fix your credit for free. So I don't want to see people going off and paying companies to help jack up their credit score, because in my mind, you're just throwing it away. There's lots of good online resources there. Burhan, thank you for the info. Is it true that your credits kind of recycles itself after 7 years? Yes and no. So for the most part, yes, your credit score is constantly a chalkboard that's constantly being written on, and then 6 to 7 years it keeps getting erased, except for foreclosure. If you ever go through foreclosure and it gets fully completed, that never comes off your credit report. It's going to be on there for life. If you go through bankruptcy for the second time, it's going to be 14 years. It'll be 14 years for that second bankruptcy to fall off your credit report. So yes and no. As long as you haven't had those couple things go wrong, then after 6 years, generally 5 to 6 years, even 7, your credit just kind of wipes itself. Brian, have collections bothering me, and was it going to affect my mortgage renewal in 3 years? No, Brian, it's not going to affect your renewals. You can renew with your same lender as long as you keep up with your mortgage payments, and that lender is not requiring you to resubmit any new credit application. You shouldn't, as long as you're with that same lender. You just keep going with them. That shouldn't be a problem. Catherine, will settling a collection affect my credit score, or if you pay the whole amount? Well, your credit score would probably be similar to the same when it comes to whether you settled it or paid it. I have about 5 or 6 years ago worked with a client where the particular mortgage we were working with, it was going through Scotiabank. There was a bit of a caveat in there. They had a collection, and if they settled the debt, they weren't going to do it. But if they paid it in full, they did. So, and luckily enough, that client didn't settle the debt. They paid it in full. We got proof that they paid it in full, and the mortgage went through. So in that instance, if you're going to save $200, don't settle it. Pay it in full. If you can save thousands of dollars, $2,000 or $3,000, yeah, probably a little bit more worth it to settle the debt. But for the most part, if you can, pay the full amount, just in case it's going to come back and haunt you. So this is just on being the difference between being pre-approved and pre-qualified. 666 Dynamax. I have a question. My broker got a rate hold for me for 1.74%. This is 1 month ago. And then he ended up renewing early. And that's great. 1.74 a month ago was okay, but rates went down after that. We did see better rates than that. So, why would he end up going with a broker? Well, because the bank was just concerned about just keeping him as a client, whereas his broker was just making sure he gets the best interest rate. So at least that's how I like to operate. So maybe he renewed a bit early and missed out on closer to 1.5% rather than 1.74. And then he and I went back and forth a little bit, but basically, there was maybe a little bit of a higher rate there as renewal than he maybe could have gotten. Rusty, thanks for your video. I'm a new mortgage agent trying to help understand about mortgages and being self-employed. Now, probably about once every couple of weeks to get somebody reaching out as a new agent, a new mortgage broker, or being licensed somewhere, and trying to get some information on how I can, help them get through the courses and stuff like that. I typically, it's not my job to sort of train new agents and new brokers. My best advice that I can give to, and this is what I reply to all of them, is to go and work at a brokerage, not as a broker, but as an administrator. Go and take applications and look at credit reports. Work with a good head broker that's going to show you the ropes and show you how the process works. Do that for at least 3 years. At least 3 years. It's typically, an hourly position. You're not being paid commission. You're not working with the clients directly. You're just learning the inner workings of how mortgage applications work, working with the underwriters and that sort of thing too. So that's a really valuable process to learn. Learn that process before you jump in as a new agent, just going out there finding clients and muddling your way through. So by all means, get the training, get into the industry, absolutely, but don't just jump in, leave your job as a carpenter and then go do mortgages once you get licensed. There is so much to learn, and this is a full-time job, and you need to take it seriously because you're putting people's homes in your hands, really. And that's about it. So when it comes to the comments on my YouTube channel, like I've said, thank you so much for being positive and just being respectful. And I couldn't be more happy about how things are going with the channel. And thank you once again to all the subscribers, and also thank you to the people who are not subscribers and who'll still watch my content and comment and help to bring a little bit of good news in the world here when it comes to mortgage lending. So thank you once again. If you have any questions, by all means, send me a message through my website or throw me a text or give me a call anytime. So I always put my contact information below in the description. So thank you once again for subscribing and helping me grow this channel, and looking forward to doing more videos in the future. Okay, have yourself a great day.